If you want to build a globally diversified portfolio, you can do that with just two funds, a global equity fund and a global bond fund. However, there are some extra choices you have to make with a bond fund, which you don't for equity. And that's the duration of the fund, which affects its risk, but also whether you currency hedge your bond fund. I'll also split it into chapters on the UK, so those are the UK choices for bond fund, and the second half will be choices for US investors. And then I'll end with my personal preferences for the best fund in each category and each region. So let's look at your choice of global bond fund in a bit more detail. Let's begin by looking at the role of bonds in your portfolio. So this graph tracks the value of three different funds. The first is an equity fund, that's shown in red. That tracks the S&P 500, and that's the SPY Spider Fund. Notice how there was a huge crash in that fund during the sell-off at the beginning of 2020, and that was a result of the pandemic. I've also shown SHY, which is a short duration US Treasury fund that only buys treasuries with 1 to 3 years maturity. And in light green, you can see here at the top, a fund which tracks long duration US treasuries, that's TLT, and that only buys treasuries which are 20 years or longer in maturity. Notice how SHY has very low volatility. It's almost like cash, and it rallied very little during the equity sell-off in 2020, whereas TLT was much more volatile. That's because it's a long duration fund where the price is very sensitive to yield curve movements in the United States. A tiny shift in the yield curve moves the price of this fund a lot. And that fund rallied much more because when people are scared, the entire US yield curve shifts downwards. And the funds which have the greatest duration are the ones which rally the most, such as TLT. So the reason why many people buy bonds in the first place is to hedge their equity. When equity suffers a large sell-off, people get scared and they buy US debt often. So you don't buy US treasuries or government bonds generally because they generate a lot of income. They don't. You buy them because they hedge your equity positions. The other risk that you take when you buy bond funds is that yields rise, because when that happens, the price of bonds falls. And that's exactly what's happened since the beginning of the year in 2022. So I've tracked those three same funds over the period of time since the beginning of the year to the time I made this video. And you can see that the S&P has fallen by just over 10% over that period of time. But simultaneously, we've seen yields increasing in the US. And as a consequence, the price of the bond funds has also fallen. And as you'd expect, the TLT fund, which has the greatest duration, has fallen more. So that's fallen by about 4% since the beginning of the year, whereas SHY, which has much shorter duration, much less volatility, has only fallen by less than 2%. So if you do think that interest rates are going to increase a lot, you'd probably go for a shorter duration fund. If you think interest rates aren't going to move much and you want a better equity hedge, then you'd go for longer duration. So that's the trade-off you're thinking of when you choose your bond fund. And as always, you should be thinking about base rates. What's the typical situation in a given year? So if we go back to 1900 and look at the average return since then, you can see that equity has generally returned much more than bonds. In fact, on average, it's returned about 4.5% more per year. So for every dollar or pound that you put into bonds, on average, you'll be underperforming over the long term. So that's why if you have money that's going to be invested for decades, it probably makes sense to put as much as you can into equity. However, if you're not going to sleep well at night, generally bonds fall by much less than equity, so they're seen as a kind of shock absorber in your portfolio, which will let you sleep better at night. They don't come with no risk because yields can increase, but generally the crashes in bonds tend to be much smaller, and when equity does crash, as we've seen, generally the bonds will rally or keep their value. So really bonds are a kind of safety net to ensure that you don't get too scared when equity sells off. The most commonly used global bond index is called the Global Aggregate Bond Index, and the company that maintains it is Bloomberg. Here you can see its description of the index on its website. But to summarize, it contains both treasuries, those are bonds which are issued by governments, but also corporate bonds. Those are bonds which are issued by companies. But all of those bonds are investment grade. That means they come with a credit rating of BBB- or higher. That means that you're very likely to get paid your money back. So you're not taking much credit risk by buying the bonds which are in this fund. Another consequence of that is that the yield, the income you receive for it, will also be pretty low, particularly in this environment where yields are generally low everywhere. Secondly, there's also a constraint on the currencies in which those bonds will be denominated. So that's restricted to 28 currencies globally. And this doesn't just contain developed market bonds. It also contains bonds from emerging markets, although they have to satisfy that rating criterion, so they can't be poor quality bonds. Now, I found the fact sheet on Bloomberg's website, which describes their Bloomberg Aggregate Index, isn't great. So the fund that you can see here, AgU, is actually an ETF which tracks that index. And by looking at the contents of this fund, we can infer the contents of the index. And in fact, there are many variations of this fund, some of which are hedged and some of which are not. And we'll come on to the hedging later. So let's start off by looking at the sector composition of the bonds which are in the index. Now you can see the vast majority of them are treasuries. Those are government bonds mostly issued by developed market governments. That makes up well over half of the fund. But then you also get things like agency bonds, so that might be Fannie Mae and Freddie Mac bonds, which are actually US mortgages packaged up into bonds. And you also get corporate bonds. So some will be in the banking sector, some are in the consumer non-cyclical sector, so those would be defensive companies, and some will be in communications, some in consumer cyclical, some in tech, and so on. So there's a real mishmash here of government debt, corporate bond debt, but also mortgages which are packaged up into bonds. And if we look at the geographic breakdown, it's no surprise that the US dominates, although not as much as it does for equity, for example. So US bonds make up 38% of the total. Japan comes second at 13%. That's roughly in line with its equity market cap. But maybe this comes as a surprise to you, but China makes up third place. That makes up 8% of the total number of bonds. The rest is very much dominated by European and developed market issuers. If we look at the credit quality of the bonds in the fund and the index, you can see that quite a bit of it is AAA. That's the highest credit quality there is. But we also have some AA, single A, triple B, but nothing below triple B, because that's the cutoff for investment grade. Now, if one of the bonds in the fund did get downgraded to something which was sub-investment grade, in other words, it became a junk bond, then the fund would have to sell that bond next time the weights were rebalanced. And because this is a bond fund, we should be obsessed with the duration of the fund. Because remember, a long duration, which is measured in years, would generally mean the fund is much more volatile. And that means it's very sensitive to yield curve movements. So if we look at the effective duration of this fund, it's around 7 years, which is kind of intermediate. It's not particularly safe, it's not particularly risky, it's somewhere between SHY and TLT, which we saw at the beginning. Now let's consider whether we should currency hedge our bond fund. So let's consider for a moment that we're sterling investors, we're based in the UK, and our portfolio is denominated in sterling. But the vast majority of the fund, as we saw, is in US dollar denominated assets. That means that if sterling strengthens versus the dollar, the value of those assets will fall when we convert it back into sterling. So strengthening of sterling versus the dollar will reduce the value of our portfolio, and weakening of sterling versus the dollar will actually increase the value of our dollar assets. So the thing to bear in mind is that this can add additional volatility to your portfolio. Currencies move up, they move down, and actually they move more than the underlying bonds in the bond fund. That's often the case. So what I've plotted here is the volatility. That's the typical annual percentage price move for currency, in this case, the dollar versus sterling. And there you can see that it moves on average around 9% per year. Now beneath that, I've shown you the unhedged version of this global aggregate fund for UK investors. There the volatility is not much less than it is for that currency pair. Now that volatility doesn't come from the bond fund itself. Most of it comes from the currency movements. And in fact, if we compare that with the hedged version, the sterling hedged version of the fund, where there's a derivative embedded inside the fund that cancels out all of the price movements in currency, there the volatility is only 3.3%. And that's driven by the bonds themselves. So you can immediately see why people choose to hedge bond funds. The volatility from the currency movements is much bigger than it is from the individual bond movements. So the risk can be swamped by currency. And that's why some people choose to hedge away that risk. So the currency movements might be positive for your portfolio, they might be negative, but by hedging, you just take away those movements. And all that's driving the returns on your bond fund will be the movements of the bonds themselves. So if it is safety you're going for, you can see why some people choose to currency hedge the bond portfolio. Bond funds are something that we discuss all the time in our Patreon community. There's also lots of members-only content to which you get access if you're a member. To learn more about that, just click on the link beside me or in the description beneath me. So now we've got some of the background out of the way, let's look at some of the actual funds which are available for UK investors. So here are 3 global aggregate trackers which are available for UK investors. Notice how none of these are hedged, they're all denominated in dollars, so you'd be taking that currency risk of sterling versus the dollar. In particular, the risk that sterling would strengthen versus the dollar and remove some of the value of these funds. All 3 of these funds are pretty big, 538 million in assets under management for the first one, 168 for the last one, so they'll probably be around for a while. And if we look at the management fee for those 3, it's very low. So for the cheapest, it's 0.1% per year. And that's because these are very liquid bonds in the fund. Now, these 3 funds were ones which I found on Just ETF, which I find very useful for finding European exchange-traded funds. Now, if you do want to currency hedge your fund, these are the choices which are available. Notice all 4 of these say GBP hedged. And if you're ever confused about whether a fund is currency hedged or not, you'll see hedged GBP in the title if it is hedged. If that's not there, then you're taking the currency risk. So for these 4, you're not taking that currency risk, and there will be a derivative inside it which cancels out the movements of the dollar versus sterling. Notice also that hasn't increased the fee for these funds, which is around 0.1% for these 2 in the middle, and just 0.08% for this very small fund, which is from Amundi. Then there's a big jump up to 0.2% management fee for this one from Xtrackers. Now, because all 4 of these are tracking the same index, there isn't much to choose between them other than the management fee. So that's in your favor. Competition amongst fund managers means that it's cheaper for you to track this index. Now, there are actually 3 which are dollar hedged versions of these trackers. Why would you ever choose one of those? Well, notice that this one says AC. That means that it's an accumulation fund, and that means that all of the dividends, which are actually the coupons from the bonds, are reinvested back in the fund. That means you're not going to get little dribs and drabs of cash in your fund, which you then have to reinvest. So personally, I think that's very convenient, and I may even be willing to take the currency risk in order to have the convenience of an accumulation fund. Now let's consider UK funds which have shorter duration. That means we'll be taking less interest rate risk. So I thought I'd show you how to use the actual ETF screener on the Just ETF website to find your own bond funds. So you go to ETF screener here, and then you choose your bonds, and we're going to choose region, which is world, and then we'll choose maturity. So let's choose 0 to 3, which is the shortest duration category. And here you can see we've got 11 funds which satisfy those criteria. And what I always do is sort by expense ratio, so I go from cheapest to most expensive. So notice that some of these are denominated in euros, some are in sterling, and some will give you exposure just to UK bonds, and some will give you exposure to European bonds, say. Now, I'd probably steer clear of European bonds because they generate a very small income. Gilts at least have a high yield. So this might be one that you could consider. It's also an ESG fund if that's something you like. But the other thing to watch out for is whether it contains corporate bonds, such as this fund here. Because if it does, then remember that you'll be taking quite a bit of credit risk, potentially, if it's not an investment grade fund. If it doesn't say high yield, it's probably investment grade. But just bear in mind that when equity sells off, usually you get a spread widening, which pushes down the value of corporate bonds relative to government bonds. Now, one of the funds I like is actually offered by Vanguard. It's this Vanguard Global Short-Term Bond Index Fund. So it's not an exchange-traded fund. It's actually a mutual fund or an open-ended investment company. But what's good about this one is that it's an accumulation fund and its fee is very low, just 0.15% per year. Plus, it does give you global diversification. So if we scoot down to see which index it's tracking, it's the Bloomberg Global Aggregate, but it excludes US mortgage-backed securities. Those are those mortgages which are packaged up as bonds. Now, this one isn't currency hedged, so you will be taking the currency risk with the individual bonds and the currencies in which they're denominated. But we do know that the duration of the bonds is short, and that means we'll be taking relatively little interest rate risk. So if interest rates do increase in developed markets, you won't take much of a hit with this bond fund. Now let's look at US aggregate bond funds. Now you probably noticed that I put the word global in parentheses, and that's because many of these are not global bond funds. These instead track the US sub-index of the US aggregate global index. So that's just US bonds. But as we saw, that actually makes up a big proportion of global bonds. But is it globally diversified? No, it's not. If you did want to get global bond exposure, then you could certainly go for something like BNDX, which buys bonds which are part of the global aggregate, but which excludes the US. So for example, you could buy AG combined with BNDX to create that global exposure. And you'd buy it in the ratio of 40% to 60%. To simulate what you'd have with a global index. Now, another thing to notice here is that the expense ratios here are very low for the US, lower than they are for the UK, for example. So the cheapest expense ratio here is just 0.03%. That's almost free. If we look at low duration US bond funds, again, you can see the expense ratios are very low, between 0.04% and 0.15% for this lot. But again, these are not tracking global bonds. These are just tracking US treasuries. But again, that's a very large liquid market, so this probably isn't a huge restriction for US investors. Another set of choices which US investors have is to buy floating rate bonds. So instead of having their coupons fixed when they're issued, these bonds reset the coupon according to the level of interest rates every quarter, say. And that means you're not fixing the rate of interest you receive, and you're also not taking big duration risk. So the duration of these funds is very close to zero. In fact, it's just a reset period, which is usually just a quarter of a year. So these are very close to having no interest rate sensitivity at all. Some of them contain corporate bonds, so for example, FLOT does. Others just give you exposure to US treasuries, which are floating rate. The ones which do contain corporate bonds will have a higher yield, but of course you're taking greater credit risk. So that's the kind of trade-off you have to consider. And the expense ratio for these floaters tends to be higher. So the lowest is 0.14% for this FLTR fund, for example. So let's end by looking at my favorites. For UK global bond exposure, my favourite is the iShares Core Global Ag Bond UCITS ETF, which is dollar hedged and an accumulation fund. That's quite a mouthful, but the fee for that is just 0.1%. And I like it because it's an accumulation fund. For most people, you don't want to reinvest those little dividends, and I think that's just much more convenient. For UK low duration fund, I choose that global short-term bond index fund, which is created by Vanguard. The fee for that one is just 0.15%. And again, this is a currency hedged fund, and it's also an accumulation fund, which I like. For the US, the global aggregate index, which I like best, is either AG or BND. I don't think there's a lot to choose between those two. One is created by iShares, the other by Vanguard. They don't give you global exposure, just US aggregate exposure, and the fee for them is the same, 0.04%, so very cheap. If you did want to create global exposure, you could just add BNDX, and that comes with a fee of 0.08%. And then for US low duration, I think the two funds which are best are VGSH, that's from Vanguard, and SCHO, which is from Schwab. Both of those come with a fee of 0.04%, and they both give you exposure to US treasuries, which are very short in duration. So if you don't want to take that kind of interest rate risk, I think those are pretty good choices. So there we are. That's my whistle-stop tour around global bond funds. I hope it's helped you do your own research. Don't take my choices as given, but use my kind of research methodology to find what suits you best. And, as always, thank you for listening.